What's up, everybody? It's Chris Rich here with the Realty Medics. Today we're chatting with Asad. Asad, who are you? What do you do? What's your experience?
How's it going, everybody? Thank you for the introduction, Chris. Thank you for the platform. Very excited to speak with all of you out there who are clients of Realty Medics. My name is Asad. I am a CPA with the FitBiz CPA. So I'm also one of the co-founders of the firm. We specialize in real estate tax planning, real estate investors. We specialize in helping real estate investors gain financial clarity around their taxes, their accounting, and other higher level advisory needs. We also provide fractional CFO services for businesses in the construction, home building, and contractor space. At the end of the day, our goal is to save you more money on taxes so that you can invest and increase your portfolio of homes.
And most of your clients are investors, correct?
Yes, most 90% of our clients are real estate investors.
Beautiful. So you know a lot about this realm, about what we're going to talk about today, how to save people who have rental properties, tax implications, tax benefits, some of the savings. So good
Yes.
person to talk to for that. All right.
Absolutely. We have unlimited amounts of tax strategies, and the main thing with real estate investors is that they should never ever pay taxes in the current year, right?
All
Because
right.
so strategy, so many things going on where you keep kicking the can down the road and you keep increasing your portfolio so that you never have to worry about paying to the IRS. And you should never pay more than your fair share. And that's my goal, to make sure you never pay anything if you're in real estate.
Beautiful. So what are some of the tax breaks I can expect if I own a rental property? What are some of the benefits?
There are a lot of great benefits when it comes to real estate. Well, the number one thing is depreciation. Depreciation is the biggest tax write-off for any landlord. You don't have to have an LLC. If you have an LLC and you happen to be a real estate professional with the real estate professional status and election on the return, you can have more write-offs. But if you are a landlord and you are in the business of rental activity and you have over 100 hours of active participation, you can write off a lot of expenses against your W-2 income or against your other active income if you qualify for the real estate professional status. If you don't qualify, that's all right. There is a de minimis safe harbor deduction every year. I think it's about 2,500 bucks. You can get that right off when you return. And let's say if your property is worth less than $1 million, your valuation of your property, you can automatically write off $10,000 in repairs, improvements, mostly repairs and other expenses. But you got to be careful. If it's an improvement and it's substantially different than what you used to have, that's going to be depreciated. That's going to be written off over a certain period of
Okay.
time. But in the current year, if you have anything that's under 2,500, that could be your walls, your paintings, cabinetry, lighting, anything along those lines, automatic write off.
Okay. And when we talk about depreciation for tax purposes, that's different than the value of the house appreciating on a retail market, correct? Those are two separate things, right? Just to clarify.
So, yep, those are
Okay.
completely two different things. Depreciation is just a tax write off you get
Okay.
every year. And appreciation, as you keep the property longer, you build your equity through appreciation, and that's a different concept.
Okay. Very
Yep.
cool. So what about interest? Can I write off the interest? What if I have a home equity line of credit? Can I write that interest off? What about property, mortgage insurance? Are any of those things tax deductible?
Yeah. So when it comes to loans, when it comes to interest on your HELOCs, remember it is a write-off, but you have to be careful with AGI. Your AGI cannot exceed more than $100,000. So if your AGI, which is adjusted gross income on
Okay.
your over 100,000, you can't write it off. If it's
Okay.
under, off. When it comes to points, when you have a loan, when you get a loan from the mortgage broker, there are points, right? It could be 1 point, 2 point, 3 points. Generally, it's under three. Maybe it's one or two. Those points are completely written off. So for example, let's say it's 1 point is 1% of 100,000. That 1,000 is a write off. Or if it's 2 points, 2,000, that's a write off as well.
Okay. So,
But there's some rules around that write off. By the way, there you got to make sure that there's simple rules like the points aren't excessive, the points don't exceed the value of the loan, things like that. So that's
okay.
basics.
So, are there any deductions that are specific to owning investment or rental properties?
There are quite a few deductions and write-offs that are specific to owning rental properties. I just mentioned some of those, which are repairs. When if you're an investor you've got tenants in service at your property, right? They're living at your property. You can automatically write off the repairs if they're 2,500 bucks, and it could be for each house. So let's say you have 5 homes, 2,500 times five, that's almost 10 grand. You can just write off. And in addition, you can also have other write-offs, other additional write-offs that relate to property management fees and other things of that nature, and managing the property and the accounting and legal expenses. And it's better to have your property under an LLC versus just being a landlord, because if you're a landlord and you don't have an LLC, you don't have a Schedule C, you don't get the benefit of those write-offs unless you're a real estate professional status. So if you are a real estate professional status, that means you have over 500 hours of material participation, then you can write off essentially anything and you pay zero tax. Because let's say your write-offs are, you have rental losses and you have write-offs in addition to those of 70 grand, and your W-2 income is 50 grand, your entire W-2 income is gone because of that real estate professional
Yeah.
status, 500 hours. But most people cannot meet that requirement, right? Most people generally are going to be W-2 workers. They're working 45, 50 hours a week at their jobs. The IRS is very, very careful with that requirement. They will audit you. They will look at your hours. They will see, hey, have you met the 750-hour requirement? And if you've not, then you won't be able to get that status. But there are other loopholes that we can work with, like material participation. That has 7 rules. You meet those 7 rules, you meet those material participation rules, then you can take the write-offs. And there's loopholes around that strategy, which we will bulletproof you. The IRS, again, is very heavily auditing these things, and you need a CPA who's going to be by your side, going to help you substantiate the material participation rules and the real estate professional status rules, so that the IRS doesn't audit you and take all the write-offs back. But when it comes to write-offs, the best way to get a lot of write-offs in residential property is by putting your putting your property under an LLC. And we've helped our clients do that. We've helped our clients put an LLC, all 5 properties in one LLC, and having multiple LLCs for multiple properties. But that's generally the best rule to follow. Or you can do the real estate professional status and then do cost segregation, which creates more write-offs for you.
Okay. Do you see a benefit, or why would somebody put each individual house under its own LLC as opposed to putting all of them under one LLC? Is there a pro or a con, or why do some people do that and others don't?
Yeah, absolutely. So some people will do that. Will do the uh, will do the LLC thing for asset protection.
Okay.
What we do, Chris, is if you buy a new property, you get yourself an LLC created, and then you create a holding company for
Okay.
that LLC. Now, when it comes to properties, it generally depends. If you have a home that has a lot that you have a lot of equity in, that is worth over 1 million or 750,000, or even more, we generally recommend having a separate LLC for that property. And let's say you have a property with less equity in, and it's not as valuable to you. You can put 2 or 3 of those properties in one LLC, and create another LLC for the home in which you have the most equity in. But it generally depends on your risk aversion. Depends on who
Okay.
your personality is. We've had clients in states like Massachusetts, which is heavily taxed, where we had to put all the properties in one LLC. Why? Because for every LLC, it costs like $1,000 to maintain that, right? There's a lot
Gotcha.
of expenses with the LLC, so it's okay to put them in one LLC. But if you're in Florida, you're in Texas, you're in Georgia, you can create those multiple LLCs and have one holding company under which they're all under reporting to.
Okay. That makes sense. So I know if you sell a house, there's capital gains tax. Can you talk about, length of ownership between when you buy the house, sell the house? Um, what does that look like?
Yeah, absolutely. I do want to talk about that as well, but I know we talked about write-offs and deductions, and I went a lot into the real estate professional status. I do want to touch on something we talked about before, which was the write-offs. And if you are again, if you are an active investor, you can automatically write off $25,000. $25,000 automatic write-off if your AGI is under 150 grand. So
Okay.
that's another benefit for investors.
Sounds like a good one.
Yeah, good tip for all of our clients, investor clients, and people looking to invest in real estate. Now, you asked about capital gains, Chris. The capital gain situation is very tricky. It's very tricky because there are rules around that, right?
Okay.
There's the home exclusion rule, which is great for homeowners, but if you're an investor, you're not going to qualify for that. So for the investors, there's something called the 1031, the like kind exchange.
Yep.
That is something that investors would really like. Now, when it comes to homeowner exclusion rule, you have to live in that property for 2 out of 5 years for it to qualify as a homeowner exclusion and no capital gains. And now, if you make 250 single, and I believe it's 475 or married filing jointly, so that's if you make those if you fall in that range, you can exclude any gain. And if you lived in 2 out of 5 years, you exclude the gain. But if you are an investor, which I believe most of the people watching this video today are, you're going to have to be very careful. You're going to have asset protection. Number one, we're going to help you with that, right? We're going to help you create asset protection. Number one, do everything with LLCs, nothing under your personal name. But 1031s essentially allow you to exclude the gain by rolling the proceeds from the sale of a home into a like kind property, right? It could be two properties, two lots. It could be a single property, just like the one you have. But there's certain rules around this. There's certain rules that you have to follow,
Does
Chris.
it matter if I go from one state to another state?
No, it doesn't matter.
Okay.
As long as the property is similar in value and similar in mortgage, similar debt, and similar in the value, right?
Okay.
If it's 250, the other property has to be 250. If it's 350, the other property has to be worth 350. It's That's just how the IRS has structured the rule. Now you have to find that property in 45 days, and that's where it gets very tricky. And our investor clients start sweating, and they go to the
Okay.
CPAs and the QIs, a qualified intermediary. Hey, I got to find this property in 45 days because you have to complete the entire transaction in 180 days. If you
Okay.
don't do that, the IRS will not allow the 1031 exchange.
Now say I'm in New York and I have a house that's worth $500,000. Can I sell that house and 1031 it into two $250,000 houses in Florida? Is that possible?
That is possible, right? If
Okay.
you find two properties and the total value of those two properties is 500,000, you can absolutely do that.
Okay.
But if it's a property that's like 750 and yours is 500, the IRS won't allow it.
Okay.
If you're getting a commercial when the one you sold was residential, the IRS is not going to allow it.
That's
So
not like-minded or like properties. Okay. And then with the 1031, basically, you don't pay the capital gains tax until down the road, right? At what point do you pay those taxes?
It's down the road. You never pay the tax because it's already rolled in into the next
Okay.
property. So you're shielded forever. It's a tax shelter, which unfortunately the current administration looks is looking to phasing it out. Hopefully it won't happen, but it's always a risk that it'll go away. You know, in the
Okay.
80s, we had a lot of these strategies like real estate professional status, deductions, bonus depreciation, 1031, all of that was put in the 80s. But now times have changed and things are changing. So the tax code always changes, right? Who knows in the next election, after the next election, new rules could be put in that could be more favorable to real estate investors. But at the moment, the environment is not friendly to real estate investors.
Okay. So what's a tax segregation study? I know a lot of people have heard about it. I don't know how many people could really explain it. You think you could?
Absolutely. So, cost segregation study is something which is very simple, very easy. It sounds very complicated, but it's not. It's something that has so much value, which is a hidden gem of real estate. If you're in real estate and you do a cost seg study, it's great for commercial property owners, but for residential, it's a must because you have bonus depreciation, but cost segregation, essentially what it does is, let's say you have you have land, right? You cannot depreciate land. Let me explain in basic details. Land cannot be depreciated, but the building, the structure of the building gets depreciated, generally over 27 and a half years. Commercial properties depreciated over 39 years. Within the structure of the house, there's cabinetry, there's floor, there's appliances, there's HVAC, there's roof, there is
Things that
garage.
suffer wear and tear and usage.
Exactly. All those items within that home can now be accelerated on their depreciation. So let's say it's 15-year, let's say it's 10-year, right? Those components, cabinetry, HVAC, roof, all of these are 15 or 10-year, probably 20-year. All things can now be deducted in the first year, meaning you depreciate 100% in the first year. Boom. What does that mean? That means in some cases, $80,000 refunds, $100,000 refunds because of the benefits of write-offs,
So
right?
let's
You don't.
say, so let me make sure I'm understanding this correctly. So if I buy an older house that's 30 years old, I can do a tax seg study and basically get back because that house is depreciated so much that there's value that's missing now from the house. Is that what you're saying?
So what I'm saying is, if a cost segregation was not done on that property in prior years, and you do a cost segregation study this year on that property, I don't care if it's 30 years, but it could be 30 years, 40 years, whatever it is. You buy that property this year, and no cost segregation was done, right? By the owners. You do a cost segregation this year by putting tenants in service. It has to be in service. Boom, that's where you generate all the losses, the write-offs on your return. You're the owner, and that's where you get the refunds.
Okay.
Cash up.
But it has to be an occupied rental property, correct?
Has to be in service, has to be occupied rental property. You can't just buy a property as a landlord and do a cost segregation. That doesn't qualify, but you have to put it in service, and you have to do a cost benefit analysis, right, Chris?
Okay.
Because these cost segregation studies are quite not. I don't want to say expensive, but the value that they bring, there is a price to the value, right? There's sometimes commercial cost segregations cost 15 to 20 grand, but residential is a bit lower, maybe around 10 to 15. I've seen as low as like 9 grand in my experience. But if you're getting $80,000 back, even $50,000 back from the IRS because of this cost segregation study, it's a no brainer.
To that
It's a no.
point.
Yeah.
By a lot.
Yeah, because
So
here's the
good.
The cost segregation is detailed. It's an entire book. It's not just like a pamphlet you hand to the IRS. It's an entire, because it's heavily audited, because the IRS doesn't like giving money back. The government does not like giving money back to you, to the taxpayer. They have to give money to you if you have losses and you're writing it all off and you're generating refund amount owed to you. But it's it has to be a book. It has to be a detailed engineering based study. You can't have a CPA doing a study. You can't have an accountant doing a study. At our firm, we have an engineering team that goes to your home, takes the pictures. You have contractors that do all the study. You have an engineer in house that creates the report. It's a book that you provide to the IRS, and then the IRS has enough substantiation that, hey, we can write off the cabinetry, we can write off the roofing, we can write off lighting, we can write off HVAC, and we were writing off all these things.
So we're talking about tax seg studies, things you can
Yeah,
deduct, cabinets, countertops, things of that nature, flooring, and you get a whole booklet from to give to the IRS, right? Talking about the value of that. So just continue on that line of thinking.
absolutely. So, Chris, the cost segregation study essentially reclasses, again, that we talked about, reclasses these different components within the building, within the structure of the home. And as soon as that's reclassed, you take the 100% depreciation in the first year. What does that mean? That means if you have multiple properties, you can do multiple cost segregation studies, right? And you can gain up to $80 to $100,000 in refunds from the IRS. What's better than that? But you need a very detailed and engineering based study for this cost segregation work. What we do is we send out contractors, we send out our team to the home, we take photos, we look at everything, we analyze it, then we create that report that the IRS looks at. And that's how they allow you to take the write offs and the losses in the first year of your home investment property and gain the money, get the money to put into more properties. And think about it, you're saving, let's say you make 50 grand every year, 50 grand over the next 5 years, it's 250 grand. Wow. That's 10 properties, 10 new doors. Who knows
So let's say
what
I've
happened?
got 5 investment properties. I do a tax seg study, and I'm going to get back low number 50K. So you're telling me the IRS is going to send me a refund for 50K?
It could be way more than that. I've seen refunds. We've done cost segregation on commercial properties. On one commercial property, the owner got a refund of 120 grand.
But on the residential side, what's most common?
Residential side, because it's lesser units, lesser HVAC, lesser components, it's going to be a little bit less, but I've seen anywhere from 37 to 45 grand minimum. So minimum 37 to 45 grand. We've seen if it's a 4 bedroom house, 3 bedroom house, you could be well over 50 grand.
Okay. Would it
Yeah.
be a good idea if I had 5 properties? Would it be a good idea to do tax segs on all 5 and then file them in the same year? Or would it be a better idea to do one a year? Or what's kind of your opinion on that?
It depends on how you want to do this. So let's say you haven't done cost segregation in prior years. You're looking to do it this year. We don't have to go and amend it. We can just do the cost segregation on your current tax return, and boom, we take care of all 5 properties for you on the return. It doesn't have to be 1 year per property. It can be all 5 in one
Okay.
year.
And then that makes sense because then you're getting a larger return. You can acquire more properties, and those properties are going to, for value, appreciate over
Yes,
time. So that
exactly.
seems like a pretty smart approach. Is there How would it impact it if I bought a distressed property and fixed it up with the sole intent of renting it? How would that impact the value of the cost segregation? And can I write off any of those repairs or
So
upgrades?
Chris, that's a great question. The repairs and upgrades are definitely a write-off, 100% write-off, but only if you are a real estate professional. If you're a real estate professional status, you get the 750 requirement, or you meet the material participation rules, which is 500 or more hours. You qualify as somebody who is a landlord in the business of rental activity. You get you can write off 60,000, 50,000, 70,000, right? You can write it off if that's your expense. But you have to make sure that you are either reps or material participation rules are being met. And you want to make sure that the property is in service. So if you do a cost segregation, you want to make sure the property is in service. Another rule to look out for, Chris, is to make sure that they're all that if you have a new property, you do you write them off, but you make sure you get a cost segregation report done because the
Okay.
cost segregation report will then help you write off these new appliances and new items.
Okay. So, um, for the average person though, they have one house, they have one rental property, cost seg makes sense for them, right? Even though they don't have that big of a portfolio, would it still make a lot of sense for that person?
Yeah, absolutely. We recommend. I had a client a long time ago who was like, "Oh, I only have one property," and he's like, and he doesn't wanted to do a cost segregation. He was against it. He said it's not worth it. He couldn't be more wrong because 3 years later, 3 years after he bought the property, he did a cost segregation, and he ended up getting a $60,000 refund after he did the cost seg. You know, he had to go back into his prior year returns, look at everything. He hadn't taken any depreciation, hadn't taken any cost segregation. We did it in the third year, and boom, he was able to qualify. He was able to get all those write-offs, the losses, wrote off his W-2 income, and helped him gain more, savings by doing the study. So even if you have one property, do it immediately. Make sure you get asset protection done, LLCs, and start working on the cost segregation.
Yeah, because most of our clients, most of our owners are not going to hit that threshold of 500 hours in a year. You know, you're talking 3 months worth of 40-hour work weeks. So most people aren't going to hit that threshold. So it's really, I think that's where the itemizing it comes in, and the value of a CPA, just from what you're telling me, I think is really the benefit for the average um, real estate investor who does not have a huge portfolio. But
Absolutely. Yeah, if you're a one rental property owner, get in touch with us. We can help set you up with a business because having a business is key. If you even if you consider it a side hustle, the business is what generates additional write-offs versus just being
an
personal,
individual.
yeah, individual.
Okay. What's the climate of your investors when it comes to the real estate market? Are they still investing? How do they feel about Florida specifically? What are you seeing with your clients? Because they're all over the country.
They are all over the country. Some of them are in Massachusetts, some of them are in Michigan, some of them are in California, some of them, and real estate, as you know, Chris, is hyper localized. So prices are not the same in all parts of the country. We have some clients who are in Florida who have a lot of long-term rental properties, and they are hesitant to invest. They're kind of bearish right now because they're looking at the market. They're looking at they're looking at the economy. They're shaky. They don't know if the prices are going to go down more, or the interest rates are going to go up a little bit more. It's all up in the air. But they're more bearish. But then we have other clients who are more on the fix and flip side, where they invest maybe they put in some capital into a property, in a distressed zone, in an opportunity zone, and then they fix it. They sell the property, make about a 30 to 40 grand profit. They get out, they get in, and within 3 months they're out. Those type of clients are doing well. They still have opportunity, they still have investments going on, but there are other clients that are sitting on the sides, just waiting on the economy to improve.
So that makes me think of something. Can you 1031 a fix and flip property?
You can 1031 essentially anything.
Okay. As
So
long
10,
as it's
1031,
like-minded.
yep, as long as it's like kind and it's got similar value, similar mortgage, you can 1031 it.
Interesting. Just thinking out loud. So if you took a old property, put 50 grand into it, and say, buy it for 150, put 50 grand into it and sell it for, say, 250, you're gonna make 50K cash
But
on
you,
that. Could you
but
flip?
you got to make sure that you move the money to a similar investment, not a new investment.
Okay.
Meaning that the proceeds, you can't keep the proceeds, right? They got to go through a qualified intermediary. They're gonna execute it, and that's how it happens.
Okay. So then I
Yep.
couldn't take out that extra 50K profit. I couldn't pull that out and then do another one without paying the taxes on it, right?
Well, no, you can pull it out. You can pull it out, pay no taxes. But I'm just saying you gotta have a qualified intermediary that does the sale, does executes the sale, and then they put the money and then they put it in a new property, and that's how you avoid the taxes.
Okay.
But it's the same uh, concept. The only thing is you got to make sure you have a QI who's in between handling it
Okay.
all.
So Asad, if I'm like sitting here thinking, I'm like, I got one rental property, I've got my own primary, I don't know where to start for taxes. How much is it going to cost me to call and talk to you to see if it even makes sense for me? How much is it going to cost for me to call you?
So if your clients, your investor clients want to give us a call, call us at 407-990-2002, 407-990-2002. We provide free consultations, and then we don't do hourly fees at all because we're not times have changed. We're not like the other firms. We're very innovative in the way that we work. We provide value up front, and the payment that the client makes is very little compared to the value we provide. So the first 15, 20 minutes, we speak on the phone, absolutely free. We make sure that it's a fit for you, fit for us, and that's how we proceed. Because generally we're working on advanced real estate tax strategies, which are very, very lucrative for investors. Like we talked about, the cost segregation, real estate professional status, material participation, business asset protection for LLCs. It's very complex work. So it's needs based, analysis based, and then we provide the package.
And then so you kind of tailor the cost to each individual client instead of a one, H&R Block's going to charge you, here's $300 to do your taxes. So you're gonna based off that consult know kind of how much work's going to go into it, and this is what
Yeah,
you're going to need to do to maximize your returns, and then you
right.
quote it that way. Is that how it goes? All
Exactly.
right.
And we might not be a fit for somebody who's just looking to get a tax return done and get write-offs, right? That might be more of maybe a TurboTax or an HR block or something like that. But if they're their own rental property, they're looking to invest in rental properties, they're looking to do proper asset protection from the get-go, they're looking for a tax plan, savings, refunds. We're the firm to do that.
Beautiful. Is there anything you think we should say or anything I didn't cover that may be beneficial to the investor, to the long-term property man, or even short-term? Um, I know there's a lot of different aspects to it. Is there anything we didn't cover you think we should?
I think we covered everything. If your clients need more free resources, free additional information, and understanding how they can take leverage of the situation, how they can jump right into the refund mania with real estate, go to our YouTube channel. It's Asad ASAD Ahmad AHMAD CPA. That's a lot of free videos on reps, on cost segregations, on write-offs. Everything is there. Get in touch with us, www.fitbizcpa.org. And then again, the number is 407-990-2002.
Beautiful. Well, Saad, thanks for your time. Thanks for the information. And if anybody has any more questions and wants to speak to him directly, he just told you how to get in touch with him. Have a great day, everybody.
Take care.